Welcome to episode 46 of the Cashflow Connections podcast. The topic for today is how Mathew Owens supercharges his self-directed retirement with 68% annual returns. That's right. Today we're going to talk about one of my favorite topics to discuss on the podcast, which is self-directed retirement. As many of you know, I'm a huge proponent of these type of accounts. They are essentially retirement accounts which allow you to invest in anything, including private equity real estate, while maintaining the tax advantage status. So very favorable for a variety of reasons, including the flexibility and the control you have over your own investment funds. I think they are truly the most underutilized financial tool in the US, and if you get started early enough, they have the capacity to significantly change your entire financial outlook, particularly as it relates to retirement. So today we have a very experienced guest who has really done a lot in different types of real estate, but he also has a background as an accountant and really thoroughly understands these tax-advantaged accounts. But perhaps more importantly than that, he is willing to share some of these secrets that he has learned throughout his career absolutely for free on the show, so you better buckle up. So today we're going to discuss how you can potentially get around some of the income limits for contributions when it comes to IRAs. This is definitely something that's a hindrance for a lot of investors. We're also going to discuss how Matt has been able to leverage his existing funds in his retirement with his ability to raise capital so he can literally 4x his annual returns, which is really incredible. And we're going to talk about some of the different options out there and what Matt really thinks of each of them. So there's, traditional IRAs, Roth IRAs, solo Ks, SEP IRAs, etc. We're going to talk about each of those plans and which one would be beneficial in certain circumstances. I have personally paid thousands of dollars going to seminars to learn about this topic, but it's all available for you for free because that's really what we are all about on the program. Now, also, I have a pretty exciting announcement, which is that the speaking lineups for Freedom Fest, which is taking place in July 11th through the 14th, has just been announced, and there is at least one major bombshell I wanted to share with you. I was actually asked to be on a panel to discuss an upcoming movie about the housing bubble in 2008, which I'm really excited about. The movie centers on some of the Austrian economists that really predicted the crash and what their thoughts are about going forward as well. But here's the thing. Here is a list of the people that are going to be on the panel with me. Peter Schiff, Doug Casey, Jim Rogers, David Tice, and Gina Lofton. The whole thing is being moderated by Gene Epstein. I'm going to go ahead and just let you pause it and rewind it and listen to that list again because it's going to take a second to sink in. That list contains some of not only generally some of the most influential minds in the investment space, but on a personal level, people like Peter Schiff, Doug Casey, they are personal inspirations to me. To be able to shake their hand or to even be in the same room as them is a complete honor. So to be able to talk about some of the stuff that, they form my ideas on a lot of these topics. So it's going to be really remarkable. And I'm also looking to hear how the panel has different perspectives because all of the people on the panel are focused on different things, different investment strategies, particularly me focusing on real estate. It's going to be a very unique situation. So I'm really looking forward to it. Either way, I'm extremely excited about, jumped out of my seat when I found out about this. So make sure to go to freedomfest.com/register. You can also use the discount code CFC FreedomFest for a $100 discount. And I will see you in Vegas on July 11th through the 14th. All right. Hope you enjoy the episode. How's it going, everyone? Today we have Mathew Owens, who is the founder of OCG Properties, which is an investment company which focuses on single-family investments. In fact, over the last 10 years, Matt and his firm have successfully flipped over 500 houses. He also has significant experience in the multifamily sector and has raised over $45 million in private capital. Matt is also a California licensed CPA and self-directed retirement account expert, as well as an overall real estate gangster. That's right. Just generally, he's the man. I'm going to keep the bio short because he's actually been on the program before. If you check out episode E18, you will find more. If you like this episode, make sure to do that. So Matt, thanks again for coming on. Thanks again, man.
No problem, man. I was joking about the real estate gangster thing. Thanks for putting me on blast there. Appreciate that. That's awesome.
Yeah, just to clarify, that was submitted by Matt per his request.
Yeah. Nice.
So, Matt, we definitely want to talk about self-directed retirement accounts today. This is something that you and I have talked about a lot on the program. We've had other guests talk about it, but just for the new listeners out there, let's start from a big picture and we can get into some of the details that I know the CPA side of you definitely wants to talk about. So from a big picture, self-direct retirement, what is it about? What can you invest in through these types of accounts?
Okay, first of all, self-directed IRAs and 401ks and retirement accounts are probably some of the most awesome things on the planet if you're trying to take control of your own financial future and control your own investments instead of relying on someone else to do it for you and probably pretty much steal your money through fees and things like that. And you really don't have the proper control and proper diversification that's required to be successful at long-term investing, without having control over your own retirement. So what's really cool is a self-directed IRA is just like a normal or self-directed IRA. When I say that, I'm meaning self-directed 401ks, self-directed IRAs, self-directed health savings accounts, self-directed pretty much anything, any type of retirement account you can pretty much self-direct. And it's really interesting because you can invest in all types of outside assets and control everything yourself, meaning you can have an LLC set up so that you can actually control it all and have checkbook control over your own retirement. It's really, really amazing, all the different facets you can do, from real estate to stock to gold and different bullion and stuff like that. You can pretty much invest in anything you want. Stocks, you can invest in other businesses. There's all types of things that you can invest in, and you're really only limited to a couple of things like life insurance and collectibles and that type of thing. And we'll get into some of the other prohibited transactions that you can't do, because you got to do it the right way, right? You can't go cheat.
Right. Certainly. And that's actually a good segue, because I think that for a lot of people, a lot of the listeners are going to be familiar with self-directed retirement accounts, but generally speaking, it's probably the most underutilized tool in the financial business because of the marketing that the other side has on their team. I know a lot of people that think that they have a self-directed account and go to invest in a private placement, and all of a sudden their Scottrade account doesn't allow them to do that. And this is really the way to maximize the flexibility, because like Matt mentioned, you can still invest in those traditional assets if you have a self-directed account. It's just a matter of you also can invest in all the types of investments that Matt and I, have invested in throughout our career. So before we jump into that, then let's talk about what you can't invest in. You mentioned some of the actual items. Let's talk about some of those, and then also structurally speaking, what you can invest in or can invest through in your self-directed IRA.
So the stuff you can't is basically just like life insurance and collectibles, and you can't do business with disqualified parties. Okay. So, and disqualified parties are typically lineal descendants. Okay. So parents, kids, grandparents, grandkids. You can do business with brothers, sisters, aunts, uncles, anybody else that you want, except for disqualified parties and like lineal descendants. Now, also like a closely held business partner can be a disqualified party. Doing business with somebody where you're personally getting a benefit out of it for doing business with your IRA could be disqualified. So like there's a thing, even though there's disqualified parties, there's a thing called getting present benefit, and neither you nor your IRA are allowed to get present benefit from each other. So like, to give you an example, if you had 50 grand and your IRA had 50 grand and you wanted to invest together with your IRA in a $100,000 note, but neither one of you nor your IRA had any more money, so you couldn't do the deal independently of each other because you didn't have enough money yourself, or the IRA didn't have enough money itself to do the deal 100% itself, then you wouldn't be able to do the deal in the first place, because your IRA and you are now getting present benefit from each other. But if your IRA had the whole 100 and you had the whole 100, then you could go through and invest with your IRA and do the 50,000 because you're not getting present benefit. And so there's a lot of situations like that. Can you buy a property next to your house and fix it up? No, because your house is right next to it. And what happens to your house when the neighbor next to you fixes up their house? It goes up in value. Therefore, you're getting present benefit. So you couldn't go through and swing a hammer on your house and fix it up yourself because your IRA is getting benefit from your labor. You couldn't own the management company that actually managed your property that was owned by your IRA if your IRA owns real estate, because you are providing labor then, even if you own the management company, for your IRA. So those are all the prohibited type transactions and philosophies that kind of go into self-directed IRA and 401k investing.
I appreciate that. And also the examples you gave may not occur to people originally, but when you start thinking it through, you have to really be detailed. And obviously you want a financial advisor to kind of review these type of transactions, one that's familiar with self-directed IRAs in particular. But yeah, I appreciate that there. In fact, this kind of touches on kind of a paradigm shift, which I think a lot of people need to understand when it comes to the nature of this conversation. So for the vast majority of people out there, the question is frequently asked, how can I get money out of my IRA? How can I get money out of my 401k? If you are slightly starting to be more knowledgeable and more sophisticated when it comes to investing, that is the opposite of the way that you should be thinking about these accounts. These are advantaged accounts. These are tax advantage accounts. So rather than thinking, man, how do I need to get all this money out of my 401k? What you need to be thinking is, how can I supercharge these accounts to really maximize the potential while I'm taking advantage of the flexibility with all these other investment opportunities? So I really think that's a paradigm shift that people should be considering. And I think that in this conversation, you'll understand how lucrative it can be to really maximize those accounts and how you can do that. So obviously the IRAs are probably the most common or frequently talked about. So let's talk about, first of all, the difference between the traditional IRAs and the Roth IRAs real quick.
Mm-hmm. Okay, so a Roth IRA, typically you're taxed now when you actually earn the money from your paycheck. You don't get a deduction for it now, but all of the earnings inside of a Roth IRA or Roth 401k, which you can have too, are taxed now, and then all the interest is taxed when you pull, or it's never taxed. So once it's in there, all the interest you earn on it is never going to be taxed unless, of course, the government decides to steal more money from us, which we all know could occur. Now, so right now, Roth 401ks, all the interest is not taxed. In a traditional 401k or IRA, it's all not taxed now. You get a deduction for it when you put it in now, but when you pull it out, when you retire, you're going to pay tax on that amount. And I think the better method, in my eyes, is dependent on what you think or what your tax rate is now and how much benefit it's going to give you for doing a deduction right now, but also what you think the long-term growth of that money is going to be. If you think the tax consequences of that long-term growth of that money is going to be much less, then you want to put as much money into these accounts as possible. And in reality, if you look at the compounding effects of tax-free interest inside your retirement account, it's unbelievable what it can do for you in the long run. And in a traditional account, I would much more rather invest in a Roth than a traditional account and start building that, especially if it's a Roth 401k, because you could put massive amounts of money, especially if you're self-employed, into Roth 401ks, and even pump that up even further with salary dividend, or with the salary profit split with your retirement account.
So yeah, you're touching on something. So rather than save that for later in the conversation, let's get into it because it's definitely a clear delineation. One of the potential challenges with IRAs is that the contribution limits are relatively low. So with an IRA 2018, if you're under 50, the contribution limit is $5,500 per year. Okay, there's also some income limitations on that as well. So again, 2018, if you're making $120,000 a year, it starts to phase out, meaning you can make a smaller and smaller contribution until you make $135,000 a year, at which point you can't contribute if you're a single filer. For married couples, it starts to phase out at $189,000 and is completely phased out at $199,000. That's for couples in 2018. Again, not tax advice. This is just based on the research that I have done. But with 401ks, there's a really, really different structure out there which allows you to truly maximize these contributions. So let's talk about the 401ks and how that really works. Matt, you were just touching on it earlier, but just kind of circle back from a big picture.
Okay, I think this 401k topic is probably one of the most interesting pieces of this, because it allows you some really cool strategies. So, and I have to talk about a couple of taxes in order to talk about the benefits of the 401k. But the first piece is regarding the contribution. So if you are, if you have a 401k, obviously you can contribute, $18,000 plus to your 401k on an annual basis for your personal contribution. Okay. If you are, and you have a solo 401k, this is if you're self-employed, and you can get a solo 401k and you can contribute 25% of whatever you pay yourself in a salary. So if you go pay yourself $100,000 in a salary each year, then you're going through and you can put in another $25,000 into your 401k on top of your another $18,000 contribution. So you're literally looking at like a $43,000 contribution right there, plus your IRA contributions, plus a health savings account contribution if you're married, up to $6,750. But this is how you get much larger amounts of money into your account. And this is on a per person basis. You can do the same thing for your wife if she's self-employed with you or something along those lines, or employees and things like that, to get more money into retirement vehicles. And so keep in mind, like the 401k is probably one of the most awesome things for the fact that in an IRA, when you borrow money, when your IRA and your retirement accounts have the ability to borrow money. But in an IRA, when an IRA borrows the money, say I want to buy a house for $100,000 and borrow $60,000 of it from someone else or from a bank, then my IRA would go and buy the property for $100,000, borrow the $60,000. But I would have to pay tax on the net income attributable to the debt piece that I pay, that I use. So if I use 60% of the money was debt, on the net income, I got to pay 60% of that income is taxable at your individual income tax rate. So you're looking at basically a portion of that getting taxed. Now you get depreciation benefits against it and things like that as well. So when you're investing in real estate, so you're in a good spot there. However, when you borrow money inside of a 401k, you don't have that debt tax. It's called unrelated debt financed income tax, UDFI. And basically, you don't have that inside a 401k. So you can borrow all the money you want and leverage all you want in a 401k or a Roth 401k, for example, which even be better, and never have to actually go through and pay tax on that money. Now, there's one other tax, which is a business income tax. You're not allowed to run a business inside your own 401k. So no flipping properties consistently, no running businesses out of your actual, 401k, because it's taxed at like the trust tax rates, which are, very, very high, and you want to avoid that. But the 401k is so awesome because of the lack of taxability on borrowed funds. The bigger amounts you can put into this stuff. You can have a Roth component to your 401k as well. This is what I use for my very high yielding investments. If I have a multifamily that's a value add multifamily that I know it's going to take me a year or 2 years, and I'm going to go through and have someone else do all the work for me, then I'm going to make sure that is inside my 401k, so that way all the profits of that deal go back into my 401k long term. It's an unbelievable strategy for growth. And the idea behind it is to actually build enough capital inside of it so that the cash flow retires you, not the traditional method of thinking where you got to keep building it to get to X point because you're never going to develop enough cash flow off of it to retire. So it's got to deplete until you die broke. That's not the idea. The idea is to find investments that create the cash flow stream that cover all your expenses, retire, and build more from there to have a hedge for inflation on top of your expenses, and then retire rich and leave it to your kids or charity later on if you want your kids to build their own. So anyways, I went off on a tangent. Sorry.
Look, man, that's the reason I had you on, right? Because I want to talk about the details of all these plans. A couple things I wanted to touch on before we move forward, because you definitely touched on a lot of really important things. So the unrelated business income, right? The UBIT. That is something that there's a lot of confusion in the space around that I wanted to kind of get an idea. So the investments these syndications that I typically invest in, that Matt has invested in historically, most of them use financing to purchase these real estate assets. So if you invest in one of the syndications via a tax advantaged account, let's say a Roth IRA, you're going to have a UBIT tax associated with that investment, right? So your Roth IRA typically is not taxed, but in this instance, the percentage of the proceeds that are derived from the financing is taxed, okay? But this is it sounds a lot worse than it is, because if you actually look at the math, there's a couple things going on that need to be addressed. Number one, it's only the percentage based on the purchase price, but also because depreciation is actually factored in, many times when you invest in syndications, the net balance at the end of the year is net negative, net balanced, or basically nothing. So on an annualized basis, you're basically not getting taxed, but your Roth IRA is growing in size. Now, in the event that there is a sale, which results in a gain, you will have a percentage of that subject to UBIT, but there's also a $1,000 deductible. So it doesn't start until the $1,000 attributed specifically to the financing, which is a portion to, the financing portion of the gains. So there's a lot of hurdles. So if you look at this, you can look at YouTube videos on YouTube, for example, that will show you how to make this calculation. It's much more favorable than it sounds. In terms of the 401ks, I'd like to get your thoughts on the difference between the solo K and the SEP IRA and where you think the most favorable opportunities are, depending on a couple factors.
So I think it depends on your structure. A solo 401k is for the self-employed individual that basically has their own business with no employees. SEP IRAs, there's pension accounts, there's the traditional IRAs. There's all kinds of defined benefit plans and things like that you can set up where you can put away $200,000 plus a year if you're in the right structure. So each one of those different accounts, it depends on each person's individual situation and how and what's going to be right for them, and they need to go to like an IRA specialist that can talk about structuring and that kind of thing to determine what's going to be right for them and the primary differences for them in their situation. But the 401k is primarily going to be used just for that self-employed individual with no full-time employees.
Understood. So let's go back to Roths for a minute. I know that's how the conversation started, but I didn't want to miss out on the 401k conversation, just given how advantageous it can be comparatively.
Right.
However, when it comes to Roths, I mentioned that there is an income limit. Now, when you can contribute to Roth IRAs, for example. Now, there is a strategy out there that some CPAs think is appropriate, others maybe not, regarding converting or actually contributing to a traditional IRA and then converting to a Roth IRA. I was wondering if you could kind of explain that strategy and let me know your thoughts on it, just as an investor, not as anyone's personal CPA.
Oh, I think it's great. I mean, if you can get more money, as much money as you can get into your Roth, if there's a strategy to do it and it hasn't been challenged by the IRS, then I think you're in good shape to do it. It really just comes down to case law, whether it's a valid argument or not, and the IRS is okay with it. If there's case law showing that people have done that, which I know there has been, I think we should be fine on that aspect. Then I would say do that all day long. If you can get more money into your Roth, that's even better. So put it into your IRA, get the deduction for it, do the conversion, then you take the hit on the tax for it. So it's a wash. Now you have $5,000 more into your Roth. You're good to go. I would be putting as much money into the Roth 401k and the Roth and then the traditional 401k versus even the IRA as much as possible. Especially if you're self-employed. W-2 earners have a harder time doing that. But talk to specialists that specialize in this and see how you can do this to do it, because a lot of times when you work for someone else, they don't allow what's called an in-service transfer for you to roll it into a self-directed account and get it into your own 401k, but where you control it. It's really really kind of messed up that they're like, nope, as long as you live with us, you have to put your money with us. and let this other monopoly prevail over us, So kind of hilarious,
right.
But anyway.
Definitely. I agree. There's also some other bonuses for Roth IRAs in particular. And I'll go through these. And Matt, if I misstep here, just correct me. But
Gotcha.
basically, number one, you can make contributions at any age. Any age. You don't have to take required distributions, which is not the case in some of these other accounts. You can still make annual contributions if you convert money from tax deductible account like a traditional IRA to a Roth IRA in the same year, but those income limits would apply that I mentioned earlier. And this is what's really mind-blowing. You can actually take a distribution at any time without paying tax or a penalty as long as you take out your contribution. Like you can take a distribution to yourself, which is a contribution. So what I mean by this is that if you invest $40,000 and it turns into $60,000, you can withdraw the $40,000 as long as you keep the original contribution in there. Is that correct? Or excuse me, as long as you keep the contribution, so the gains are still in there. Is that correct?
Yeah, that's right.
Okay.
Yeah, they should still be all in there. Yeah, you're taking out the original contribution first, I believe. So
correct. That is awesome. And there's a lot of flexibility with those, which is why they're so popular. And they don't require as much financial know-how in terms of some of the other accounts.
Right.
So you mentioned something at the beginning that I definitely want to get your thoughts on, which is checkbook control IRAs. First of all, explain what that means, and then what are your thoughts on that for most people out there?
So normally when you are investing in self-directing your retirement, so you can invest it in whatever you want to invest in versus the traditional stocks, bonds, mutual funds, and things like that. When you're with a Fidelity or Schwab, that's pretty much the investments you can invest in. When you have a self-directed account, you can invest in all those other aspects we talked about earlier, like real estate and other syndications and things like that, right? And so in a self-directed, when you set up a normal self-directed account, there's usually custodians that are very similar to the Fidelity and Schwab, except they have a fee that is disclosed to you up front versus hidden to you in trades. And it's usually a small flat upfront fee, and you transfer all your funds over to them. And then whenever you want to invest in something, you do what's called a bidirectional letter. It's like one form that you say, hey, IRA custodian, please send these funds over to this closing for this transaction. And here's all the paperwork or the promissory note or the closing documents or whatever that goes with that. And you send it to the IRA custodian. They say, okay, no problem. Hey, I'm missing this document, or, oh, hey, everything's okay. No problem. Your transaction is getting processed within usually 24 hours, and they go send it out to the custodian, and get it taken care of that way. And then when you want to pay off the loan or sell it, you got to do the same thing and have them sign all the documents, or communicate with them every single time to fund the deal and make sure that all the stuff's in there. And they usually charge you, depending on the custodian. There's some custodians like Entrust and Equity Trust and some of the other larger ones. They can have different fee structures, like where they charge you based on the amount of assets you have in your account, or they charge you based on the dollar figure of money you have in there, versus a small flat fee, which a lot of the better ones, in my opinion, do. And now I'm not saying that Entrust and Equity Trust don't have their value. They absolutely do. They've been around the longest. I'm just saying, look at the fee structures for your individual situation before you actually decide on a specific custodian, and I believe those companies to be really good companies as well. I don't mean to pick on them. I just look at the fee structures specifically because they vary greatly by company and by account and how much money you have in that account specifically. So that being said, you have all this paperwork with this custodian you have to do initially, where you're just transferring it over. On the initial transfer, it goes into that account, and then you can invest those funds through those bidirectional letters or the communication with the custodian. Some people, after if you're doing one or two transactions, or don't have 100,000 or less in that account or something, then maybe you're okay with just leaving it that way, right? Leaving it with the custodian, because it's not a ton of activity to deal with. There are a lot of investors that have $1 million or 500,000 or want even complete control over their investment, where they can cut checks and do all that kind of stuff back and forth themselves, like if they own a property. And so they want to have more control. And so what they do is they set up an LLC that is owned by the IRA. Now, this is not something you can go set up through LegalZoom. You have to have an attorney go write it so that it has the right legal wording in there, that is specialty wording, because it's owned by the IRA and you are the manager of that LLC. You are not the owner of that LLC. You and your IRA are completely separate entities. And so in that case, when you're dealing with this, the LLC is its own entity, that your IRA is buying shares of that LLC. So now it owns that LLC. So any funds that you put in there is now the IRA's LLC, but you are the manager. And now you can open up a bank account, cut checks because you're the manager of that LLC. You can buy properties inside of it. You can invest in syndications. You can track everything inside of it. You can cut checks. This is good for a lot of property ownership because there's like utility bills and mortgage payments and, insurance bills and property taxes and all kinds of other little things and repairs that could occur that you got to cut checks for. And a lot of times the custodians will charge you, $15 fees every time they got to cut a check, So it starts to add up after a period of time, or after X amount of checks per year, they'll usually cut those, or usually after 12 deposits a year, they'll also start charging you for deposit fees. So that's why it's much better sometimes to have it into another account or have your management company paying for all those things instead, if you don't have one of those accounts or one of those checkbook controlled LLCs set up. So does that make sense? I know it's a long-winded answer, but it was kind of important to kind of go through the different aspects and show you what the reasoning is behind it. It's really for the control, better fee structure, so you're not getting charged all these fees, and not have to go back and forth, especially if you have a lot of money in that account. You can completely control it. You sign the releases and things like that versus your custodian, that type of thing.
Totally. And I think the key there is that at the beginning of this conversation, I said, these are really special accounts. These are tax advantaged accounts. You want to protect their integrity. So if you have a structure like this, you have much more flexibility, you have much more control, and you don't have a third party saying this is a good idea. Basically, your custodian will say, hey, this is, they may say, look, that you're about to make a mistake, which could challenge this tax advantage account's nature. So if you don't have that, you're able to, yes, the transactions can move more quickly, but you may make a mistake that may challenge it. So it's just something to be very cautious about. Now, there's a lot of people that are flipping houses. We talked about this briefly. Let's get an idea of where you think it's appropriate in terms of flipping houses inside an IRA. You have a flipping business. Are you actually conducting a business within your IRA if you have a flipping business on the side? What are your thoughts on how to balance that?
So see, that's a very tough thing to do, I think, too, because so I have not read the case law on this, but according to people that I've talked to that have read the case law, so it depends on a couple of factors. One, how often you're doing it, inside and out. Like me, I'm a full-time flipper. I flip 5 to 10 houses a month every month. I've been doing it for 10 years. That's not easy for me to say that if I flip houses inside my IRA, that I'm not running a business inside my IRA or my 401k. So because I do it outside of it, I'd have to typically hold, and I've done this before, held a property for rental purposes for 1 year, then realize the long-term capital gains associated for that. And, I buy it, renovate it, tenant it, wait, a year basically from my purchase. I'm renting it out and then I'm selling it long term. Now, I don't plan this. It does not necessarily plan to sell it, but it's all about the intent. If I had planned to sell it necessarily, then it might be considered a flip, right? So it's all about your intent associated with it. My intent is to rent it, and I'm proving that through the rental. And then in the long term, I'm going through and reselling it and just realizing those capital gains faster, but I do it on a smaller scale. I like to invest in outside ventures like larger multifamilies that are not associated with that, or debt where I can leverage my investment and make a higher return as well, versus necessarily flipping inside my 401k just because of the danger associated with it and what it looks like to maybe an uneducated IRS auditor or something doesn't understand what I do. Does that make sense?
Yeah, absolutely. It's just balancing that scale, what's appropriate, how large the IRA is,
Right.
how willing you are to put yourself in that position. Very much like you, I am a huge fan of the Roth IRA. I think it makes a lot more sense, especially if you have access to favorable investments because the growth is tax free. So when someone comes to me and says they have a traditional IRA, my first instinct is to say you should convert that. Number one, you convert it to a self directed IRA right now, and you should probably roll that into a Roth IRA. But of course, everything is more complicated than that. I'd like to get your thoughts on what are the things people should be considering if they're thinking about converting from a traditional to a Roth. For example, I know age is a really important one, but yeah, balls in your court. Let me know what your thoughts are.
So yeah, it depends on your life situation. Personally, I don't think that if you're looking at retirement, I don't think the traditional methods of retirement, the stocks and bonds and mutual funds are smart investments right now. You look at the stock market, it's at all-time highs. Yeah, if you were out of it right now, you would have probably not had as many gains, but at the same time, you're not risking a major loss either from a major downturn. I don't feel like you have control over that. And so the amount of money you have to develop into cash flow streams is extremely important. So I'd be cashing out if I had a lot of money in the stock market right now and in those other outside opportunities. But, I don't invest in those things. So I invest in real estate and things that I can control. So take my advice on that with a grain of salt. I just look at the economic side, and I'm very much into economics. So I'm seeing that risk associated with the decline there, and then not being able to provide enough cash flow if there's a major decline. So personally, I look at, if someone's nearing retirement, you got to get your money into cash flow investments as fast as possible. So you're not relying on up and downs on the market. So you don't have to actually sell because something doesn't cash flow well. Like stocks typically don't cash flow very well. You're not getting very much in dividend payouts. But if you can invest in strategic high cash flow other investments and diversify correctly, then you're going to have a good long-term stability on your cash flow. Now, if you're younger and you don't have a lot of money and you got, $5,000 or 10 grand in an IRA, it may not make sense necessarily to go self-direct until you can actually go through and get enough money to pay for some of the fee structures and things like that, or do an actual investment. Now there's ways, if you know how to leverage other people's money, to leverage 5 or 10 grand into like $100,000 type deal or something like that, or more. But at the same time, you need to know how to deal with other people's money at that point. And usually, most people don't have that experience yet to know how to protect an investor's money and how to secure their money by property and how to do it the right way. If they don't have a ton in their traditional IRA or 401k yet, or don't have significant real estate investing experience.
Yeah, definitely. How do you kind of balance, let's say someone has a self-directed traditional IRA, do you balance, because obviously when you convert from traditional to Roth, there's going to be a tax event. So at what point do you start to say, okay, look, you have the self-directed traditional IRA, you should consider converting it to Roth so that the future gains can be tax-free?
Yeah, so you're just talking about a traditional IRA into a self-directed Roth conversion, right?
Exactly.
So you can do Roth conversions, and you have to pay tax on that conversion. I don't remember if the new tax code still allowed that. I know last year it did. I'd have to go specifically look up the rule for 2018 to see exactly about the tax code change, if there was any change to that this year as far as not being able to do Roth conversions, because I believe it was limited on time as far as how much you can do. But we can look that up. But at the same time, so when you're dealing with traditional into self-directed accounts, it's really rather easy. What they typically need to do is if they quit their job and they don't work there anymore, at their where they have their previous traditional IRA and they want to put it into a self-directed, all they have to do is fill out a transfer form and open an account with the new custodian, and fill out a transfer form that gives to the old custodian, and have them do a transfer and roll it right in. And it's like $50 or something like that, with another $300 setup fee or something along those lines. So it's not substantial. So it's really easy to do. It usually takes a couple of weeks to get the transfer done, another 10 days to season in that account before it's ready to actually go. okay, and be invested into something. And so that's pretty simple. Now, if you still work for the company and want to that you have your 401k with, and want to transfer that over, then typically you have to do what's called an in-service transfer. Most of those companies won't allow you to do it, but at the same time, every single HR person will tell you they can't. But you should read the plan documents yourself, because every plan document is different. Sometimes they allow an in-service transfer. Sometimes they allow a partial in-service transfer. So these are the types of things that you want to look at inside your plan documents if you want to start taking control and self-directing your stuff yourself.
Cool. Which you definitely should look into, especially if you're listening to this podcast, because you have access to some really great opportunities out there. Now, let's talk about the gravy. I would like you to share an example of a deal structure where you felt like you were really able to maximize your contribution to your self-directed retirement account, maximize the protection as well as the return profile.
So you want an example of, explain that one more time?
Yeah. So an example of like a deal that you've done, you've seen a client do where you felt like they really maximized the potential of these retirement accounts, whether it be leveraging via debt or purchasing via equity and doing some kind of workaround, whatever you think is like a good explanation of kind of the summation of this conversation.
I got you. So I'm sorry, Hunter, I'm going to blow your return on investment out of the water for a second, just to show
great.
the power of this. So I know we're all trying to sell 4% return on investment here, but this is the type of thing that happens. So, so listen, this is a structure. This is a deal that I just did that I thought was like awesome. I was just super proud of myself for this one, of course. So, I have to explain it away. So I did a loan recently to a flipper for 12% at one point for $500,000, which is a 14% annualized return. So 1% of the loan amount every 6 months. And so that's a 14% annualized return. So on my $500,000, I made basically $70,000, okay, at 14%. Now, I had all my money invested inside my 401k except for $50,000. So I borrowed $450,000 out of the $500,000 at an 8% interest rate. Okay. So out of that money, I paid $36,000 to my client on that money. And that means I netted $34,000 in profit on my $50,000 investment, which is a 68% interest rate on my money. Okay. Which is ridiculously phenomenal of weight. And what's really even more interesting in that is that my loan to value was 65% of the value of the property in the first place. The investor, which I'm in second position to, is it like at 55% of the value of the property, and my money's put more where my mouth is because I'm the one that did the underwriting for the loan. So there's really cool strategies for this, and my investor's really happy. She's making 8% at a 55% loan to value ratio, and I keep her funds consistently invested. And so it's and it's also can be short term, so she's in and out of different things. But it's a way to utilize and leverage other people's money to make money in different ways, and that's just one strategy that I'm able to use. And now, literally, obviously, making that kind of return, 90% of my money is going to that type of strategy now, because I know how to do it. But also, the other money is going to investments like self-storage, mobile home parks, multifamilies, other commercial operated deals like the syndication investments, where I can be passive but make a 10 to 15% return on investment consistently, run by an outside operator, where I don't have to do the work and be properly diversified. So if I'm not controlling it and doing all the active work myself, then I want to be diversified into all these investments so that way I'm protected. But I'm giving up a little bit of my control there from for operators that I've vetted and done homework on and background checks that do all the work for you. But we've done a lot of homework up front in order for me to want to invest in those different people, in those different investments, which can be really lucrative and great to use, especially because they can get their own leverage and you don't have to qualify for the loans yourself, which is super awesome.
Certainly. Yeah. So just to go back to that example real quick, so I want to make sure that I understand and the listeners understand it as well. So in this example, you have a 401k with $50,000 in it. You have a property that's about to be flipped. You say, I will borrow $450,000 with the property as collateral. So now you have a total of $500,000, right?
Yes.
So you have now your 401k essentially has $500,000 in it, right? So you invest that money, you're getting 14% on that $500,000. You're paying 8% on the $450,000, and that spread, that arbitrage, results in about $36,000 coming into your 401k on an annualized basis, but you've only invested $50,000.
Correct.
Well, that is a home run.
Yeah.
And just to clarify what that really means in terms of the collateral. So Matt has created a note where the first $450,000. The property is collateral, about 55% loan to value, so we're very well protected. And he's saying, look, I'm willing to go in second position so that in the event that something goes wrong, the first has really the control over that entire foreclosure process. So he's really putting his expertise on the line. He's putting his capital on the line. He's also saying, I'll go in second position. But boy, that Roth IRA, that 401k is getting absolutely supercharged. And that is really, what's available out there with a combination of the use of these self-directed accounts, the 401k, the solo K, or the SEP IRA, and, taking the use of debt as an instrument to create maximal flexibility. So I think it's a brilliant way to do that. And I really appreciate you sharing that story. And I know that we got to run in a second. So Matt, do me a favor and let the listeners know how they can learn more about your firm and get in touch with you.
Yeah, no problem. My company is OCG Properties. Website is ocgproperties.com. And if you guys email me, you guys can email me at invest@ocgproperties.com. Basically, I just help people with investments. I invest in single family, multifamily, notes, and syndications. And, sit down with clients and go over their individual situation and just try to help them. I don't charge for that type of service, but, I just like helping people on that side of things. And if I can make money with people, then great. And we have a lot of resources and operations and, do quite a bit. We've been doing this for 10 years. So it's a lot more fun than doing accounting. And I'd like to, Hunter, I'd like to end with one final thought, if that's okay.
Go ahead.
Taxation is theft, bro. Taxation is theft.
Listen, I think that's the attitude that everyone wants, right? When you're working with someone. So you used to be a CPA, you're trying to keep their money in their pockets, not give it to the government. Now you're doing the same thing via these self-directed accounts. So that's a very fair way to end the conversation. Thanks again for coming on, Matt.
No problem. All right.
All right, listeners, thanks for checking out the episode. As always, the contact information for our guest will be available in the show notes page, which is hosted on SoundCloud, iTunes, and Stitcher. Don't forget, if you want access to some of the free goodies that I'm talking about at the beginning of these episodes, like free ebooks, weekly investor emails, and articles about some of the most important investment-related topics, make sure that you have created an account with CFC because this stuff is automatically available. You can do this by going to cashflowconnections.com and signing up as an accredited investor. Of course, if you have any questions, feel free to email me at hunterthompson@cashflowconnections.com. Thanks again.